Hi everybody, this is Thomas Wynn of Wynn Capital with the 2022 fourth quarter market summary. On your screen is all my contact info, and if you have any questions or comments, please reach out anytime. Before we get started, let's take a look at the S&P 500, the chart for 2021 and 2022, and contrast and compare. On your screen over here to the left of this little dotted line is 2021, a very orderly rally. It's contained in what we call a channel, and the channel was about 5 percentage points wide, with the biggest decline about 5 percentage points in October. And then this year, we made market highs right at the beginning of the year, had a very sharp decline, a lot of rallies, a lot of declines going all the way forward. We reached a low on October 13th. We had a very strong rally in the fourth quarter. Right at the end of the fourth quarter, gave up most of that, but had about a 7% rally. And now we're up about 8% year to date. So we're fairly far from the lows, but we're still about down 20%, or a little less, maybe 15% from the all-time high. If we go back to the market summary, we're looking at the quarter across all of the different types of investments. The U.S., international emerging markets, global real estate, and the bond market. All the arrows are up, and as we saw in the chart, fourth quarter had a very large rally and then came back down, but ended the quarter up after 3 down quarters. So we're starting to recover. Time will tell if this endures or not. At least for the first quarter so far, it's been enduring. Those are the returns for the quarter, and it tells you the average returns and the best and worst quarter. The next slide takes a little longer view. It's got the 1-year view and then 5-year annualized and 10-year annualized. So despite the rally in the fourth quarter, everything is still down pretty significantly for the 1-year period. This is the quarter with the price of the market in the graph above and the news that came out during the quarter down below. I've circled a couple. The Fed activity, a very large rally happened in the middle of the quarter. The U.S. Treasury has an inverted yield curve, meaning short-term rates are higher than long-term rates, and then a headline that stocks fell dramatically. Just read the little editorial comment here. We're not implying that news is predictive of price. It's quite the opposite. It's very impossible to take the news of the day and predict what's going to happen to the news of the next day. This is a similar graph with the price versus the news, just for a longer 12-month period, and you can pause and take a look at all of the big headlines that came out during the last 12 months. We're now looking at different areas of the stock market, the U.S. and foreign developed and emerging markets, and what the patterns are. During market declines, it's normal for value to become popular. Growth is popular during big bull markets, and tech and large growth were the leaders of the recent bull market. And now people get a little bit more conservative. They're looking for stability and income and dividends, and they tend to go towards value. And that's a cycle that happens over time. Over long periods of time, value does outperform growth, so we overweight or tilt slightly towards that area of the market to try to capture the outperformance over time. Down here, the grid tells you some context of longer term returns for the 1, 3, 5, and 10-year periods. Same thing for international developed countries. Value was leading the way, and you can see the pattern that's repeated throughout all of these areas where the quarter was fine, but still negative for the 1-year period, and then 3, 5, and 10-year periods. As is normally the case in longer periods, you have positive returns from the stock market. Emerging markets are a lot more volatile and vulnerable. They have very, very high swings with high returns, and then they have periods of periodic low returns, and this is one of those periods. Value, again, was the leader. The quarter's fine. Poor returns for the 1 and even poor returns for the 3-year period in general, and then positive returns, and the 5-year period, and 10-year returns go back to positive for this section of the market. Country returns, the average is the global average right here. To the left, most countries had positive returns. The U.S. was on the slightly less than average, and since it's so big, it dragged down the average to a great extent, and a few big losers, but most returns for most countries pretty good. This is commodities, and just like country returns, very, very volatile, with often a 36% decline in natural gas and a 42% rally in nickel and other metals. A lot of commodities were up during the year. Heating oil, energy in general was volatile, with heating oil up a lot and natural gas down a lot. There's still tremendous disruption in supply chains all over the world due to many, many factors, including the Ukraine war. Fixed income has shocked a lot of people because rates rose faster than they ever rose before, and we had some of the biggest bond declines in history. I think last quarter, the third quarter of last year, was the biggest bond drop ever. And I'm talking a little bit about mutual funds or money market funds and CDs are approaching 5%, similar to what the Fed funds rate is, while market-driven, investor-driven rates over the long term remain lower than short-term rates. That's called an inverted yield curve. I've called this out several times. If you take the duration of a bond, and for instance, this government long bond has a duration of 20, you multiply it times the interest rate rise, and when interest rates rise, bonds fall. So 20 duration times 1.5 is 30, and it means the bond declined by 30, and it is almost exactly that. Bonds are almost a single factor. There are other factors, duration and credit quality and investor sentiment, but in general you can predict what a bond is going to do if you know how it reacts to interest rates. This is the editorial at the end. This particular editorial from Dimensional Fund Advisors is from the founder, David Booth, and he's one of the original group of researchers and fund managers that popularized low-cost diversified mutual funds, very similar and founded around the same time as Vanguard. And for 50 years, Vanguard and DFA have encouraged the use of low-cost diversified funds, which over those 50 years have outperformed funds that are active and they stock pick in market time. Though there's been great progress in educating investors on the benefits, there still is an enduring popularity for stock picking and market timing, and in general the relatively poor outcomes that result. So most of the clients that have gravitated to Wynn Capital have already bought into this way of investing, and we've been having good success with it. So I'm going to leave it at that. I hope you find the material helpful, and please reach out anytime if you have questions or comments. Thank you very much, and goodbye.